Hello there and welcome to this week's casual educational video. The topic, as you can see, is share buybacks, a topic that in my opinion is fairly simple and straightforward. However, even though there's a lot of resources on what it is, there's not a lot of resources on the impact that it has on the shareholders' value. Now, I noticed that the media oftentimes portray this as a positive event that creates value for the remaining shareholders, but that is something that is not always the case, and I'd like to elaborate more on that through an example. And the example that we have is a company that I've just invented. Its name is TBC, short for the best company, and it's worth $500. So we have a mature company that has excess cash, that doesn't have any opportunities to invest this cash in, and of course, keeping the cash doesn't create any value. If anything, in times when the inflation is fairly high, it destroys value over time. So the question is, what can the management do with this excess cash? Obviously, dividends is an option that is always there. It is something that is more recurring, whether that's quarterly payment or annual. But this is a bit of a different case. They want to create value for the shareholders, right? This is the story of the media by buying back shares. Now, if you take a look at the ownership, we have 5 shareholders, each one owning 20% of the company or $100 worth of shares. And for a buyback to happen, somebody should be willing to sell their shares. And in this case, we have somebody, his name is Peter, says, look, if I get a good offer, then I can put that in use. I can invest in other companies and I'll be happy with that. So on the open market, that's where normally, or in most cases, buybacks happen. There's another option of buying back shares via tender offer, but in this case, we'll keep it simple. Peter is willing to sell the shares, and the question is, what is a fair value? Now, obviously, if the company is worth $500 and each one owns 20%, $100, then that is the fair price, that the fair dollar amount that Peter should receive. And if that happens, right, this is basically a share buyback at fair value. So what happens to the remaining 4 shareholders? Their ownership has increased from 20 to 25%. They each own $100 worth of shares because the company as a whole now is worth $400. It was worth $500, but there's $100 less cash. Therefore, this is a share buyback at a fair value, and we're going to take a look at what happens with this share number 5. Now, let's assume that Peter has run his model and says, I'm not very comfortable holding this share. I'm not that optimistic about the future. So I'm happy with receiving even $60 for my ownership. And if this happens and he's wrong in his assumptions about the future, well, the ownership still increases from 20 to 25% for the remaining shareholders. But if the actual fair value was correctly calculated before at $500, now at $440 after paying the $60 to Peter, the ownership, the value of the shares or the individual shareholders has increased from $100 to $110. So this is a share buyback below the fair value, and it happens only if somebody is willing to sell his or her shares below the fair value. But let's assume that there's a third scenario where actually the management is very optimistic about the future of the company, and they decide to pay Peter $120 because they believe the company is worth a lot more than the fair value. In this case, that's $500. Obviously, the challenge here is estimating the fair value in the first place. Therefore, answering the question whether this activity creates value, destroys value, or is neutral is not an easy one to answer, and it's not one that should be answered within a minute by anybody who hasn't done really a deep dive into the company to really understand its fair value. But if this is the case, so if Peter receives more cash than the fair value of his shares, then even though the ownership again goes from 20 to 25%, the value of the shares for the remaining shareholders has decreased from $100 to $95. So in a nutshell, share buybacks can create value, can destroy value, or can be neutral. It is one way to return capital to the shareholders, and the way that it is being returned is now they own higher ownership, which means they have a higher percentage, higher proportion of the future earnings of the company. And in theory, the price is more volatile than the value of the company. And if the management is authorized to buy back shares, then they can create value if they execute these transactions at any point when the price is below the fair value. Of course, the fair value again is something that is very difficult to estimate, but they should have at least some sort of a range for that. Now, there's still one more question to address, and that is what happens with this fifth share that now the company bought back. Who owns this share? And you can pause this video and you can try to think of a logical explanation for that. Or of course, after that, you can continue watching this video. If we take a look at the shares that are on the left side, these are called outstanding shares. These are shares that are basically that the investors can buy and sell on the open market, assuming that it's a public company. And the fifth share, initially it's owned by the company. In that case, it's called a treasury share. It can be used later on to raise funds, so they can sell it back to the market and raise cash, maybe at a better price, or they can cancel it, in which case that share will no longer exist. So those are kind of the two options that are there for the management once the share has been bought back. And that also summarizes this video, as that is the last slide that I have. And I hope that it is sufficient to explain the process of share buybacks and gives you a bit more insights into whether it creates value or not. If you have any questions or comments, please let me know. And as always, I'll see you in the next one.